So, if you are a current homeowner with a mortgage or two in place on your home, and you have ever thought about refinancing, you are in the right place today. I want to have a very casual and hopefully not too lengthy conversation about why you may want to consider refinancing if that is something that you are considering doing. So, when it comes to refinancing a mortgage on your home, generally you need to look at when are you going to do it and why are you going to do it. So there are a couple of different reasons primarily that someone would consider connecting with a lender and talking about redoing their mortgage. So the beauty is, in this day and age and with the way the mortgage industry operates at this point in time, there should be no cost or obligation for you to speak with a mortgage lender to simply have a conversation about market conditions. How much do you owe? What is the potential value of your home? And basically get a feel and an overview of what options might exist for you in the context of refinancing your home with no cost and no obligation. So, if you wanted to take that conversation to a deeper level, you may get to the point, obviously, of needing to have your credit pulled. But to have an initial conversation with anybody in the lending space, whether they work for a bank, whether they are an independent lender, and obviously, I'd be happy to have that conversation with you if you have a home that is located in the state of Florida. I can help you with a property anywhere in the state of Florida. But regardless of whom it is that you might be speaking with, it could be your local bank, again, an independent lender, a mortgage broker. There should be no cost or obligation to simply engage in a conversation and see if current market conditions relative to where you are would make sense for you or give you an option to consider. So, generally, when people look at refinancing, there's in the lending world, there are two general refinance scenarios. So, one is what's known as a rate and term refinance. So, this is very simply a case of you owe money on your home and you want to see if you can improve or shorten or reduce the rate or the term on that mortgage. So, you might go from a 30-year loan to another 30-year loan, but you might be moving from 7.5% to 6.25%. So, it is simply a rate reduction refinance. You may be in a situation where you're sitting on whatever your interest rate is, but on a 30-year loan. And let's say the current interest rate environment is a little more attractive, and you want to do the refinance to take yourself out of a 30-year loan and put yourself into a 20 or a 15 or maybe even a 10-year loan. So, what would work for you and what your driving motivation is in that capacity. And that is something that could be discussed when you are working with a licensed mortgage professional to have an intellectual analysis about the pros and the cons of making a decision like that. So in the context of a rate and or term reduction refinance loan, there are a couple of key variables for you to just surface level be aware of. So if you're looking at simply and exclusively, let's say, reducing the interest rate, you're going to see the most benefit in terms of your payment reduction as a result of that by staying on a longer term mortgage. Now, depending on your household circumstances, that may or may not be the best course of action. And I am not here to give any financial or mortgage advice in this video, but simply to create awareness and help you have an understanding of what kind of conversations you could have with your lender if you choose to consider a refinance. And in light of current market conditions and news out there about interest rates, continually just kind of trickling better than where they've been in the last year or two, it is something that's coming up more frequently in daily conversations. So realize on the just surface level here, the longer the duration of the loan is going to afford you the most attractive monthly payment on the loan. The more that you reduce the term, so let's say from a 30 to a 25-year loan or a 20-year loan or a 15-year loan, it is increasing that monthly obligation, which is how that shorter term is accomplished. So, in some instances, you might find that a blended scenario makes the most sense for you. You might be a few years into owning your home and you're on a 30-year loan currently. And you don't necessarily want to start all over again on a 30, but you don't like the payment that comes along with a 15. So if the interest rate environment is better than where you currently are and the rest of the numbers in your transaction would make sense, then maybe it becomes a case of refinancing to a 25-year loan so that you're not necessarily setting yourself back in time to starting over on a 30 again, but you are allowing yourself to take advantage of an improved interest rate environment while staying on pace or maybe even improving your time frame yet to outright home ownership. So that's one side of it, if you will, in the refinance spectrum. The other side is going to be what's known as a cash out refinance. Now, cash out might mean that you're taking money out of the equity within your home and literally receiving that as proceeds when you fund that transaction at closing. So that could be money in your pocket to put into the bank, to invest elsewhere, to pay off other debts that you may have, or take a vacation, or for whatever reason it may be, you are extracting equity from your home and doing something else with that money. Now, that could be a debt consolidation scenario where, okay, let's say you owe $200,000 and between vehicles and credit cards and student loans, you owe another $50,000 or $60,000. And you want to pull that 50 or 60,000 out of your home's equity to pay off all those other bills. Now, if your qualifying details allow you to do that, you could theoretically walk away from the closing with that 50 or $60,000 just being deposited into your bank account, and then you could go ahead and pay off those other bills on your own. In some instances, to increase the loan amount and qualify for that cash back without paying the debts as part of the transaction, you might not qualify because all those payments plus the increased level of mortgage financing might mean that your debt ratio is a little too high. So in that regard, certain debts within your credit profile could be notated as they are going to be paid off as part of the transaction. So while you are still pulling cash out, you are extracting equity, you personally are not necessarily going to touch all of that money because let's say there's two credit cards, a student loan, and the balance on an automobile loan. Well, all of those could be notated as being paid at closing. So they become literally a transactional line item expense when you look at the summary of your transaction. So instead of you receiving that $50,000 or $60,000, the title company or the law firm or the settlement agent that's handling your closing would simply be taking that money, issuing a check or a wire transfer to those individual creditors to pay them off on your behalf. So you're extracting equity from your home, you're actually pulling cash out, but you're not actually touching it because the money is going to go directly to pay off those creditors. And when you do that, in most instances, those debts now do not need to be held against you in your qualifying details and debt ratio for the new mortgage. So because we as an industry or the underwriter on the file knows that these debts are being satisfied with those proceeds, then those payments tied to those are no longer in your debt ratio equation. And it could be a blending of, let's just say the vehicle loan is $20,000 and your other obligations are $30,000. Well, if just the vehicle loan is notated as being paid off and it allows the debt ratio to work for qualifying and approvability, then maybe just the vehicle is paid off through the actual closing, and then you receive the other $30,000 or $40,000 to pay off the other debts on your own. So there are, a few things to be aware of and just things to consider when you are analyzing whether a refinance is going to make sense for you. And I know from many conversations that I've had, there are times where someone is sitting with a very attractive interest rate on their mortgage currently, and they don't want to consider increasing that interest rate to do a refinance. But when you look at what all of your other debts are, and again, this is where having a consultative and intellectual conversation with a lending professional is critically important, because depending on the circumstances and the scenario and the details that you're bringing to the equation, sometimes it might make sense and sometimes it may not. So there was a scenario a couple of years ago, where I was talking to the daughter of a past client. So it was her and her significant other, and they had an attractive interest rate on their first mortgage that I think was around 4.5%. At that time, the prevailing market rate was around 7.5%. But they were living literally and truly paycheck to paycheck. They did not have very much left over each week or each month, and they had some other debts out there that didn't have large balances, but they did carry larger payments from what the original amount borrowed was. So even though she was going to be relinquishing a mortgage at 4.5%, when you look at what the mortgage debt amount was relative to the other debts that she was going to be paying off as well, it all made sense for them, because they were able to basically pay off every other debt that they have. We were able to refinance them into a loan term that actually had her a few years ahead in terms of being able to pay off her home. So I think there might have been 21 or 22 years left on their current mortgage, and we put them into a 20-year loan. But on top of that, when you looked at the outcome and the results of going through this process, it was going to free up about $800 a month in their overall household budget. So the intention in speaking with her and the game plan going forward after closing was that that was going to give them basically an extra $100 a week of just casual spending money, to not need to pull out the credit card for little incidental purchases here and there. And the other $400 that was being saved through bundling all these other debts into their new first mortgage, they were going to reinvest and add that back to their new current mortgage payment, which then was going to reduce the term on that loan down to just around 13 years. So, in terms of what this really meant to them, it created financial comfort week to week. It got rid of higher interest debt obligations that they had, eliminated all other debt obligation payments. They were not going to be changing their monthly budget in terms of um, what their cash flow scenario was. Everything was simply going to be an improvement with the elimination of the others. The new mortgage payment was going to be $800, again, less than what all their other debt obligations were combined previously. So even though the interest rate on the mortgage itself was about 3 points higher than the one that they already had, when you look at the big picture, the money that was going to be saved by being able to get that new 20-year loan reduced down to a 13-year loan, plus the increased cash flow in their household every week, it was truly, what could be considered a life-altering transaction for a scenario that at that moment in time, most people weren't thinking about picking up the phone and calling a lender when interest rates were in the 7.5% range. So every scenario is going to be a little bit unique in and of itself to both market conditions, the timing of things in the market, and tying in with the thumbnail image of the when. Yes, the interest rate environment and what is going on at that moment in time, as far as what kind of pricing you can achieve when you go through a refinance, is one part of that when. But another part of it that needs to be taken into consideration is what is the date that your homeowner's insurance renews each year? Are you in an area where property taxes are paid annually, or are you in a market where They are seasonal taxes, and they might be spring and fall taxes or summer and winter taxes. And if you are dealing with an escrow account as part of your mortgage transaction, the timing of when you go to closing relative to when your upcoming insurance renewal is due and when tax bills are going to be due can impact what the numbers look like in that overall transaction. Now, generally speaking, the timing as far as that part of it isn't usually going to make or break whether a transaction would make sense for someone, but having that conversation with your lender as well to figure out, does it make more sense to do this now, or should we wait a month and let my current lender and my current escrow go ahead and get my tax bill paid, and then when we set up the new loan, we're not having to collect and pay those taxes right away. So there's a lot of variables there. The money in your current escrow account could either be used to pay your taxes if you leave it alone, or if you were to close early and let the new loan or new lender pay your taxes, the money in your current escrow account would be refundable to you. But you don't want to be in a position of paying off one loan and trying to close on another right around the time that the check would be in the mail from your current lender to pay those taxes, let's say, because now you might be needing to get with the county to get a refund because the new loan is going to require the taxes to be paid. And if that's happening at the time the check is in the mail from your current lender, your current escrow account will have depleted the assets for your taxes. That money is going to the tax collector. And then we're, as the new lender, let's say, paying your taxes as well. So now the tax collector got a double payment, and you might need to chase down those dollars. So there's little nuances and variables that that come into play in this. And as I've mentioned in other videos, and I do have another video out that I'll make sure I link in the description down below. There is a product out there in the market as far as a home loan program that is truly unlike any other product that exists in the world of mortgages in the United States. And if your household numbers allow this loan to work the way it can for you, it almost makes the interest rate environment irrelevant. Now, that's a bold statement, but there's truth in that, because while the interest rate on any home loan is a critical component within the details of that loan, and it is very important when you're analyzing whether or not a given transaction makes sense for you, this particular product is kind of opposite of the way pretty much all mortgages in the United States work, where all mortgages are run on an amortization schedule. And even with a very small interest rate number tied to a given loan, they do tend to still cost large dollars as far as overall interest cost over time, based on the way a normal amortization schedule works. This home loan solution is a principal first driven product. And as a result of that, it can create tremendous savings for households where their dynamics and their numbers allow this program to work for them. There are many other features and benefits within this that do not exist in most other mortgage products. If you would like to learn more about this product or have any questions about how this works, feel free to message me, reach out, give me a call, send me an email. I have another video that is an overview of this particular product, and it does also allow for it allows for a consumer to not have to necessarily try to time the market in the context of a possible refinance the way you might be doing with a traditional mortgage, where you're paying attention to interest rates, what's going on today, what did the Fed do last week, what impact did that have on the overall mortgage market. With the way this product is more fluid and the way it works, it basically eliminates the need to chase or wait for a better interest rate environment, and can create opportunities for you that may not have existed without this product being in existence and available to you. So I hope you found the information in this video helpful and broadly, generally here informative. If you have any questions about anything pertaining to a refinance, if this is something you've been thinking about, just in light of hearing anything on the news or just hearing that interest rates are getting a little bit better, if it prompted you to wonder, like, what could a refinance do for me, whether that is the cash out side of things or just trying to improve your interest rate or the term on your loan, feel free to reach out. There, again, is no cost or obligation to discuss a scenario and see if there's anything that can be done that could be helpful or beneficial to you and your family. Make it a great day out there. Thanks for tuning in. I appreciate you tuning in and watching. If there are any friends, family, neighbors, coworkers that you feel would benefit from this video or would enjoy seeing this, feel free to share it with them as well. And if you'd like to be notified of future videos when they come out on my channel, go ahead and subscribe, hit the little notification bell, all that good stuff. And at any point, reach out. Always happy to help and guide in any way that I can. And what I think you probably just don't hear too often out there in the marketplace is that reaching out and having a conversation to discuss your current situation and circumstances can lead to an end result where a lender possibly is going to tell you now is not the right time, or there is no real benefit for you to consider doing this right now. There's no harm in exploring your options and having a conversation, even if there is the ability for you to improve some aspect of your financial life through a new home loan, whatever type it may be. It doesn't mean you need to pursue that. So it may be a case of, okay, if you refinance right now, we could shorten the term a little, reduce the rate a little, and it equates to this much of a savings, both now, monthly, and over time. Well, that number may not be quite large enough for you to consider moving forward with that transaction. But if you know what things look like right now, and you know that, let's say, well, if that number was $100 more in terms of my monthly savings, or my long-term savings were $20,000 more, well, then you can have a conversation with your lender about where would the interest rate environment need to be to achieve that. And then you can pay attention to the market. So if you know that in, let's say, a 6.25% market, that 5.875 is the interest rate number that gets you to the point where doing that refinance makes sense, well, then you have something to watch the news in regard to paying attention to, and have your lender set a trigger in their database that in the event that interest rates get to this target level, Mr. and Mrs. Smith need to be called, because that's their target number to achieve what they want to with the rest of the equation. So there's lots to chat about. There's lots to take into consideration. And I will probably do a follow-up video on this because I have some other thoughts that I wanted to share. But again, I simply wanted this to be kind of surface level, and just in light of the current, interest rate environment that we're in, which is definitely elevated from where it had been over the last 20 years or so, but it is definitely better than where it's been in the most recent year or two. There's inquiries out there. People are having thoughts about this. So I hope there were elements of this that you found beneficial. If there's ever anything I can do for you, please don't hesitate to reach out. Until then, make it a great day, and I look forward to seeing you in future videos. Well, hey there, if you are still with me, I am truly hoping you enjoyed the content within this video. I hope you found it informative, and I hope that I shared it in a way that it brought benefit to you and made the most sense to you possible. If you would like to be notified of future content when it becomes available, go ahead and like this video and subscribe as well. If there is anyone that you may know of in your friends or family circles that may enjoy this information as well, or is possibly going to be in need of mortgage financing in the state of Florida at any point in the future, whether that's 2 months, 2 weeks, 2 years, please feel free to go ahead and share this with them. I appreciate you being here. And if you have any topics or ideas that you would like me to address in future videos, go ahead and comment down below. I would be more than happy to see if I could address your comments or requests for the benefit of everybody. And whether or not you need mortgage financing, possibly in the future, if you are considering relocating to Southwest Florida or anywhere in Florida for that matter, feel free to jump over and check out my Life in Southwest Florida YouTube channel. There is a link to that down in the description below at any point. If I can be a resource for you, if I can answer any questions that you may have, or if there's anything that I may be able to do for you, please don't hesitate to reach out. I look forward to connecting with you, and I look forward to seeing you in future videos. Take care and make it a great day.